Alrighty, folks. One of the things that is so fun to do at one rental at a time is grow our audience of experts. And of course, we have Lance Lambert, Fortune writer, and somebody I follow on Twitter, News Lambert. How you doing, buddy?
Good. Coming to you from one of the most boring backgrounds I can. Got the corner and the white, so nothing interesting over here. But maybe I'll share my screen and look at some housing charts as we get
Yeah.
going.
Yep. There you go. Let me, there you go. Now you can do that. Yeah. One of the things that I wanted to talk about here is we're kind of at the mid-year, right? It's basically July 1st. I think it'll actually be July 1st when this video publishes. So I thought we should look at what's going on with housing. I know there's been a lot of people updating their opinions. I know we're heading into the second half, generally a slower time. I think it's clear rates are going to be higher than some of us thought, myself included. I think rates probably be up today, for example. But yeah, a lot of stuff going on in housing, and you are housing. So what's going on?
Yeah, a lot going on. This was Case-Shiller week,
Yeah.
although, and I'm never a fan of this when people try to rain on the Case-Shiller day, because I always like Case-Shiller day, that last Tuesday of the month. We had the little bit of a Airbnb stuff going on Twitter.
Yeah,
Um,
I
and
saw that.
maybe they're the right numbers, maybe they're not, maybe it doesn't matter. But let's take a look at some of the latest Case-Shiller data.
Okay.
I'm going to share my screen.
Yep.
We'll start with the year over year data, which usually I don't really focus as much on year over year because not only is home price data lagged, but resale, these repeat measurements like Case-Shiller are lagged even more.
Mhm.
And so you're already several months behind when you get that new month. But then if you do year over year, you end up getting to be like 14, 15 months behind. So you're kind
Right.
of pretty far behind it year over year. But year over year, we had finally, and this was all expected, the first year over year decline since, and really the Case-Shiller data going back to 1975 has only went year over year negative three times.
Mhm.
Uh, the 90s for a bit, most notably the housing crash when it really fell, and
Mhm.
then this one, which is 1/5 of 1% right now. And at least these next 2 months, 3 months, probably negative year over year. And the
Mhm.
only way you could extend negative year over year beyond that, and it could be that already the positive year over years are already baked in, like there's enough growth there that it's baked in already. But if you wanted to keep negative year over year going, I think you at least need to have month over month negative by August again.
Right.
And there's a good chance you would actually need it by July, because I'm guessing there's probably 1 to 2 points of appreciation that haven't been registered by
Yeah.
Case-Shiller. Maybe a little
I think
more. Year to date, 2 to 3, and I'll share the month over months now.
Yeah, I think there's one thing that's important here, and I actually called it on January 2nd. I actually said Case-Shiller would go negative 4 months starting with the April data, which this was the April data. This was all predictable because again, um, you're looking back year on year, we had a huge bubble with Seattle market or King County being 112% of list price, which is not normal. That was the average purchase price to list for a month last year was 112%. That's a sign that there's an unhealthy market going on. So again, I think Case-Shiller going negative was predictable. It will be negative next month. It will be negative the month after that. And then we can start talking. So
Yeah, then we're
that's the
still,
year on year data.
yeah, once you get to July, August, we're kind of, well, let's kind of see how it all kind of
Yes,
plays out. Now, Bank
totally
of
agree.
America thought we would not go negative on Tuesday.
I
And
saw that. I
I
did see that.
actually, Tuesday night, I got a few emails from some of the bigger real estate companies
Mhm.
and one of them predicted the year over year was up 0.6%. So
Oh,
I almost panicked Monday night going into
yeah.
Case-Shiller. And because if that had been right, that would have meant that month over month had rose 2.5%.
Oh, it would have been a monster beat. Yeah.
And so I was kind of like, because some of those places might share data with each other beforehand. And
Mhm.
so they kind of look at it. I get the data about a half hour before the release.
Okay.
But I was a little panicked on that, but it came in right where everybody had kind of thought, which was we
Okay.
would get that very small year over year down in April. So let me share the Case-Shiller. I went back and got this data from Robert Shiller.
Hmm.
going back to 1975. Because online you can only get back to 1989 for
Oh,
Case-Shiller, but here's
nice.
the historic. You can see the overheating in the 70s.
Hmm.
Um, and most notably, when you're in a period of overheating, the latter half of the year keeps overheating. That's where you really start to get those big yearly
Interesting.
gains. And then you go into the early 80s
Hmm.
and you have the mortgage rate shock. And in the Case-Shiller, never went down year over year for 19.
I think that's really interesting because one of the things that I did, and I think I've showed you my 50-year
Yes.
spreadsheet. 81's an interesting year because that's
Yeah.
where rates went up. That's where transactions crashed. That's why it was so easy for me to call the 40% transaction crash because the data told me. But to
Yeah.
see that Case Shiller really never went back to back negative
Yeah.
after that is it just goes to show you that it all higher rates do is crash transactions, not
Yeah, yeah,
necessarily price.
it's interesting. Now on that one, if you look at the Fannie Mae index, it
Hmm.
went negative year over year in like 82,
Hmm.
but the Case-Shiller one didn't.
Yeah.
I'd like to, I don't quite know why, but it's the same thing now. Fannie Mae's not going to go negative year over year in Case-Shiller,
Right. Yep.
which is interesting. And also Fannie Mae didn't go negative in the early 90s one, while Schiller did.
Oh,
Um,
interesting.
so slight different methodology, so I'm not exactly sure. Then you kind of come out of that and you're kind of in a lull here. This is very normal, very
Hmm.
normal. This is kind of driven by that savings and loan money out west and
I
in
remember.
Texas. You have
I
that
read
boom,
that.
you have the bust. And then in the early 90s, and this is how a sideways market looks. And I actually think it's important to look at this right here
Okay.
because what you have is you go into the year, you get your appreciation, and then at the end of the year, it gets knocked off. And
Got
that's
it.
what kind of was happening in the 90s. You'd have a
Hmm.
normal spring market, it kind of was getting knocked off a bit. And you
Hmm.
had that for a while. And it's interesting that you had that because in the 90s, you had strong income growth, a good economy. But what you did have is a lot of building too in the 90s.
Mm.
So that's an interesting time. And then at the end of the 90s, you get that overheating again. Uh,
Look at that. That is wild.
yes.
1.6, 1.5, 1.5 down at the bottom.
Yeah.
Woo.
And here, if you're going to get a big year, you're working in the second half of the year. If you keep the appreciation going at the end of the year, that's where your year gets to be big.
That's
Um,
interesting.
and then you have, and this is not seasonally adjusted. I wanted
Okay.
people to see everything. This is just how it actually works without the adjustments. So this, and you have, you know, you get to '06, you have that spring market, you're a little bit off. And then '07, not a normal year at all. Same with '08. And this is to get a real bust year, like a real down year, like 8, 10%, you have to have no appreciation essentially in the spring. And then you just take it off at the end of the year. That's when you really start to work down. But even if you look at this, the worst crash ever in history, it still took 5 years of this to kind
Exactly.
of play out. Um,
I wish more of the doomers and crash bros would understand. I'm not against a housing crash. I mean, it's mathematically possible, but it's never in the time frame that they select. The worst ever, the housing related 50% adjustable rate mortgages, it took 5 years to play out.
yeah,
Crazy. Okay.
yeah. And then so here you have the past. Well, so 12, 13, you had a very big spring. That's a lot of those institutional people. They're like,
Yeah,
we're
they
buying
stepped
this.
in. I'm buying. I
Yep.
remember that time frame. Yep.
And then you went into what has been our normal seasonal pattern, which
Hmm.
is around a 1% each month and some losses maybe at the end of the year.
Yeah,
Um,
makes
and then
sense.
2020, we break out. And
Hmm.
as soon when you do this at the end of the year,
Yeah,
that's
that's a
going
bull
up,
market.
you're going up real big. That continued into 2021. And then a lot of economists now believe that somewhere in here, the Fed got behind. right? On rate,
Mhm.
on the actual rate environment.
Yep.
And so when they played catch up and they allowed the spring market to happen where there was little to no inventory and 3% mortgage rates and all that
Yeah.
overheating, I mean, that's a 2.7 for 1 month.
A
I mean,
month.
that,
Annualize that. That's crazy at annualized.
you know what? That's yeah, that was the biggest ever for 1 month, was that March 2020, which is kind of in the actually happened probably January, February, but
Yeah, those are
um,
when the contracts were. Right, right, right.
rates spiked. And at this point in June, we were up for the year nine something in Case-Shiller. And
Okay.
by the time you blew off this 4 or 5 without adjustment, we finished up like 5.7, 5.2 ish for the year.
Okay.
And then you come into this year, and in my opinion, one of the hardest parts about making this year a down year is this February reading. Because what you really needed to do is you needed to take some of that losses from the end of the year, and
Right. Carry them
needed to
forward.
be
Yeah.
more declines in December, really, to kind of
Mhm.
pull over. And then in January needed to kind of be down too. But we started off so warm that February was up. Because then what happens if you add a real down year? If let's take 2011 right here, you start 1.1 down, then 0.9. So that keeps you down for the year, even with this appreciation up until about May, June. And
Yep.
then the end of the year, you can kind of knock it out. When you're only down January, but then you go up February, you're in a tight spot to get down mathematically for the year.
I agree.
And 1.3 and 1.3, those are big readings. I mean, if you look from 2014 into 2020 spring, those 7 years, we did not have a 1.3
Wow.
at all. So we've been very warm this spring. And I expect May will probably be a number just like those two, based on what we've already seen from the other ones. And then
Mm.
we're probably really going to decelerate fast around here. And we kind of see what happens at the end of the year. But already, just with the 4 readings, we're up for the year 2.3%. So we're up 2.3. There's at least 2 more to go, maybe 3. And then the back half of the year, you'd have a real challenge trying to knock that off.
Yeah.
You would essentially need a second half of the year that is like 7, 8, 9, 10, 11,
Right.
2022. Those are the
Yep.
only 5 years since 1975 that delivered enough of a drop in the second half of the year that would be able to wipe out the first half of 2023's gains. So getting to a down year would be tough just based on the history of the chart.
Yeah, and I think the other things that we've seen, and again with my other experts that come out each week, is inventory is really a problem, right? Existing home sales. And let's just play a game for a minute. Let's say rates go to 8%, right? Today I think they'll go over 7. Let's say they go to 8. Say they go 8.5. That dents transactions more. I think it was somewhere on Twitter somebody said, and I gave him credit, and now I forgot who said it, but the Fed is broke housing supply more than it has demand, which is wild to think about. Everybody looks at demand because it's part of the affordability calculation, but they have broke supply. They're the whole move up buyer, the spring selling season didn't transpire because there's so many people trapped in not moving. If rates go to 8.5, that's just more people not moving.
Yeah, but I think well, it's like, why did we get up to 8 would be the question. But I think if we actually went up to 8 in the second half of the year, which that seems kind of far away, because
Mhm.
we'd have to really, I mean, yeah, you'd have to take what, the 10 year to
4.5.
4.5. I mean, yeah,
Yeah.
plus, yeah,
I
it
was
seems
just I was just
but
playing it out because
yeah,
higher rates in the second half hurts demand. Everybody gets that higher rates hurt demand. I want more people, Lance, to appreciate that higher rates hurt supply. I don't think enough people understand that.
yeah, I hear you though, but when you take off those new listings, it hits the supply and the demand. And so the only reason I'm a little like
Sure,
pushing just a little bit is because we'll take Austin. Austin's
sure.
still down 25% year over year for new listings,
Yep. Okay.
but inventory is up um like 70, 80%. And that's because days on market went up 190%. Now
Days on market. Yeah.
the markets like Boston and a lot of these warmer markets, their days on markets didn't go up anything like that. So it's like how much of a shock can you give to a demand?
Okay.
And it would vary by region too. But I see what your point is. And 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 even before the mortgage rate shock, we didn't have much supply. Demand and supply were misbalanced,
Correct.
and we're still misbalanced. And it's in favor of the seller. And tight resale supply went into the spring. We had enough of an acceptance on the demand side. They're like, oh, prices are not crashing right now. And and once it got competitive, it kept going. And you see the spring, we're getting just a little more appreciation than a normal spring.
Yeah.
But yeah, it's interesting to kind of see how it'll play out.
And then the
Uh,
other thing that I think is transpiring, Lance, is that buyers, right, the demand part of the equation, they're getting used to 6% mortgage rates, 7% mortgage rates. The first time we got here, demand stopped. We're back here again. Now we're back here again. I think this is our third go around with 7% mortgage rates. It appears that demand's kind of getting used to that.
that's what I'm getting to is that's like, so the mortgage rate shock hits, you take out the move up buyer, right? The
Mm-hmm.
list, so the listings drop, but that
Yep.
also takes out the move up seller and the move up buyer.
Agreed.
The buyers on the sidelines who get priced out by the mortgage rate shock, it pulls them back very quickly initially, but
Mm-hmm.
as they come in, there's no corresponding improvement on the supply side to meet them.
Correct.
So as more of that acceptance comes, it just adds to the heat of the market.
Yeah.
Yeah, and now if mortgage rates moved up again, you would probably have fewer new listings, more of a hit onto that move up side, and
Mm-hmm.
maybe briefly you hit demand, but it still has that part where they go to acceptance. Like
No,
at
I
some
agree.
point they keep accepting.
Yeah.
And it's been interesting to see how it plays out. So my data tool can't put all the data for this type of bar chart since 1975, but here's since 1990. And you
Mm.
can really see the springs are when you work in that appreciation, and the second half of the year is when you kind of things slow down with the appreciation
Interesting.
side. And that cycle just goes on. And this chart, I really like it because you can see in an overheating period where you really get the fact that you're still up in that second half of the year, the fact it doesn't drop back down to the zero bar in the early 2000s, and then in the early 2020s, 2020 second half, 2021, that's when that appreciation really starts to add up. And so it'd be interesting to kind of see where this bar maxes out at, and then what it looks like in the second half of the year. Um, is it going to be like these 1990s where it goes up and then you have a little bit off in the second half of the year? But if you look at this line, these 1.3s,
Mm-hmm.
it's one of the bigger spring markets, or
Wow.
it's
Yeah.
just like we were talking, it's just above the 2014 through 2019 ones. And this is without seasonal adjustment.
Right. Right. So when we look at all of this, what are the experts calling? I know the experts had an opinion coming into January. We're now into July. Are you seeing the experts kind of get closer together? Because I think there was a pretty wide spread at the start of the year. We
Yeah.
only had 6 months left. Where are people coming together at?
Coming into the year, the last few months, things started to get pretty bearish with some of the calls.
Yeah.
24 of the 29 were negative for the year. And the peak to troughs were really kind of ranging, and we started to get a few of the 21s.
Mm-hmm.
As soon as the year started, we essentially got all the revisions started to move in one direction, and that was revised upward very quickly.
Okay.
As we
Yep.
go into the year, the market has stabilized, spring appreciation returns, resale supply is very tight, the economy is very strong, so there's no new listings that are from like sellers losing their jobs, really. Like
Mm-hmm.
there's none of that. And the outlook's revised upward. And now we're kind of mixed in terms of like uh, like everything's kind of condensed itself.
Okay.
But we're still kind of mixed on like who's positive, who's negative. But the negative ones for the year, they never say this with their outlooks, but there's a chance where the models are saying, okay, we still think it's going to be negative for the year, but the economists who are building these models in their own heads are like, I don't know about that, because if you
Yeah.
look at the data that's coming in this year, we're in kind of a tight spot if we could hit that. And so I think that's kind of where we are, is where some of the models for the year are still kind of negative,
Okay.
but it's like, we already have 4 of the month's readings of the 12 for the year,
Yeah.
and you're already baked in for 2 or 3. And then, oh, look at the real-time data right now. And yes, there's seasonal slowing, but it's not like seasonal slowing that looks like a second half of the year where prices are going to move down, let alone
Right.
enough to wipe out spring appreciation. So I think that's kind of where we are right now. One of the interesting ones is the American Enterprise Institute, who went
Hmm.
very bearish right at the end of the year, which I was kind of surprised by. They thought peak to trough 15 to 20,
Oof.
which was always surprising because they were one of the groups who was very early to the fact that home prices would overheat during the pandemic. They were like, hey, this is going to keep running double digits. And they were actually still calling for another double digit price gain when prices peaked in June 2022. So they were
Okay.
always very bullish. But then they got very bearish.
Hmm.
And then almost immediately, each one of these new monthly reports that they put out, they've started to revise upward. And now they think that this year we're going to be up like 5 to 6, and that next year we're up 7.
Oh, wow.
Historically, a typical year is 4.6 for appreciation in the Case-Shiller. So
Right.
a 5 or a 7, those are up fairly big. Um, and that would be it would be interesting to see if that's possible,
Right.
uh, but a little skeptical given how pressurized affordability is, and the fact it's going to be very hard to get any appreciation at the end of the year, as you move into that seasonal slow period
Yeah.
when that affordability crunch could actually start to work against you more.
Yeah.
Zillow is still, they went right back to being bullish.
Hmm.
They think 5 uh, over the next 12 months. CoreLogic is one of the only ones that did not ever think we would go negative year over year.
Okay.
And they think their outlook is now 4.6 for the next
Hmm.
12 months.
Okay.
Fannie Mae still thinks it'll be down like 1 this year and then 2 next year. Freddie's kind of like in the same place. Moody's, I talked to Zandy this morning. Zandy had said that, his personal outlook of the 10 doesn't look like it'll happen. He thinks it'll be closer to 8. The model, the last time I had looked at it, and was 8.6. I don't know what it is now. Maybe it's closer to
Just so
8.
we're clear, when you're saying 8 and 8.6 was Andy's model, that's a home appreciation over the next 12 months?
No, no, no. 8 is the peak to trough for
Oh,
the
I'm
site.
sorry.
Yeah.
Got it. Got
So
it.
like the Case-Shiller unadjusted went to 5.2 last year. So to
Got it.
get 8, you would have to retest that bottom plus 3.
Got it. Understood. Sorry.
And now what happened is the Moody's model went to that, but then Mark, his personal outlook went to 10, is what he would tell
Mm.
people, 10% peak to trough. But now he's kind of like pulled that back on his personal outlook, but I think the model's still in the same spot.
Okay.
So
I
he's
got
essentially pulled his outlook back to what the model's at. And his view is, affordability is so pressurized that as we get some of the economic weakening, some of the price gains would get
you. Okay.
taken off.
In the second half. Got
But
it.
if that doesn't happen, the scenario where prices hold really firm, it's just less activity, is what he says. It just very low existing
Yeah,
transaction activity. And he thinks for
absolutely.
new home sales and existing sales, that those have bottomed out, which I think a lot of people, obviously new home sales, you look at the numbers,
Yeah.
they're up a lot. So it'd be hard to not say they have bottomed unless you think there's a double dip. And then his view for rates is still 6.5 for this year,
Oh, wow. Okay.
uh, which is what he came in at, and 6 by the end of next year, and then sometime in 2025 get to 5.5. And his long-term outlook is 5.5. Like
Okay.
if you look at the economic fundamentals where we are, he thinks 5.5 for rates.
Yeah. I was going to ask you about new home sales. You brought it up. That was a huge beat. I think 12% beat. I for the one can't imagine why the experts, I don't know who these people are surveying, actually thought new home sales would be down month on month. I think
Yeah,
last,
who are these people that Bloomberg gets?
I
Because
don't
their
know. That was
Schiller
horrible.
number, supposedly their Schiller number, they thought the one we just got was a beat. But then
Okay.
all the emails I get from these different groups were thinking that Schiller would actually be up a little more than it was for
Hmm.
this past month. And that most of the people that I was getting emails from thought that new home sales were going to be up like I was getting like 730, 740, 750. I was getting a lot of these hot
Okay.
numbers. But then you look
Nice.
at the Bloomberg expectations and it's
I don't get it. They
way
need some
less.
new experts. They're clearly not in the market, because when I'm out shopping for a home, we spent 3 weeks looking for a home. There's nothing in the existing market that's even close. We had to go buy a new home. And then of course the builder gave us a 499 30-year fixed. Good luck getting that today. So,
Yeah. Yeah.
just
Well, builders need to be a little careful too, for the second half of the year to not go too much up, pull
agreed.
back much more from the incentives now. Pulling back in March, April, fine. But as you kind of, they're probably going to get a little more conservative for the second half. And then
Mhm.
next year, probably, well, we'll have to see. That's kind of
Yeah.
far out. But,
Yeah.
DR Horton CEO, when I talked to him this week, he was saying, yeah, there's a possibility that, they, some more of those incentives pull back.
Yeah. I think, one of the things is really the new builders are in a very great spot. Their competition, which is the existing home sale, is not really showing up. They're obviously building in, and they have the ability to buy down rates in the back end. It's a good time to be at least it's a good time to be a
Yeah.
public
Well,
builder.
yeah, DR Horton's thing was what he said is the price cuts they made
Hmm.
going into the year and the which they call the pricing adjustments, and then the incentives
Yeah,
just giving them an edge. And then, like you said, the lack of resale supply, and especially the lack of like resale supply of things people actually want.
that's
Um,
exactly right. Move in ready. I
yeah,
think there was a Twitter out on Twitter the other day talking about home improvement projects, people backing off those. People don't want to take on the projects. They want move in ready stuff, which is really what we were looking at.
Yeah,
Ended
and
up getting.
you would, in one hand, you would think people would try to go for more of the fixer uppers because affordability is so strained. But
Mhm.
then for a lot of people now too, affordability is so strained, and so it's just so expensive to buy something and then also
Yeah,
repair.
and then fix it. Yeah, it's
Yeah,
tough.
and then the Fed has also taken away that piggy bank of the
Hmm.
refinances,
For sure.
which has kind of affected the remodels, but. I think you and I talked about this last year is there's probably still a good long-term outlook on the remodel side, just
Mhm.
because even beyond this, like there's still going to be people locked in by these low mortgage rates.
For sure. Yeah, they're I mean, I ask people probably once a week who's moving, and most people say they're never going to get rid of their 2.8, their 2.9. So at some point they're going to add a bedroom, add a pool, whatever it is, because they're going to make where they are better.
Yeah. And I think the immediate effect on the new listings data trending down is obviously the lock-in effect of people like not wanting to sell and to move,
Hmm.
right? But over time, there could be some of what you've talked about, which is like the accidental landlord, where they're
Yep.
like, okay, they're ready to sell now, or they're ready to buy something new now, but they're like, well, I don't want to get rid of this mortgage rate. It's
It's an
so good.
asset.
I'll just keep it as
Yep.
a rental. I don't think that has like a huge macro effect on the data now, but I think there's some of that over time.
Yeah, it'll come in.
Any
It'll come in.
marginal loss in, the new listings has an impact because there's just so little of it.
I agree. And then I'm just curious, since I got you, we'll do all of this in one video. What are people talking about mortgage rates? I'm seeing a lot of people kind of estimate around 6.5. I think
You, you
Mortgage Banker said 5.6. I couldn't believe that. It's crazy.
it's tough because the economy continues to be stronger than expected, and it's
Yeah,
just
today's numbers.
and
Wow.
and so it's just keeping the rates higher for longer, not
Hmm.
necessarily higher, but it really should be not higher, it should be high for long.
High for
um
long. Yeah, I like that.
yeah,
I like that.
because higher implies that it goes even higher, which maybe it will. But the outlooks are still thinking that by the end of the year, rates are trending down.
Mhm.
and that next year rates trend down even more.
Okay.
So we'll have to see. But a lot of, these mortgage rate forecasts have really struggled. I mean, the
Yeah,
home price
yeah.
has also struggled,
Yeah.
but the mortgage rate forecasts have really struggled too. And so the side that both of these have struggled on is new home prices. The models could not detect the overheating that started during the pandemic. It moved very quickly, very fast, faster than the models.
Yeah.
Then on the decline side, where the models were good was telling us, even as rates started to move up, okay, there's going to be a very fast historical deceleration in appreciation. The models got that. But then the
Yep.
models started to get pretty bearish. And, we'll have to kind of see how the cycle plays out, but it doesn't look like it's going to go right there, at least based on the data we're seeing right now. So that's on price. On mortgage rates, the forecast went into 2022 still thinking we were going to stay in 3 and 4 range. And we
Mm.
were hit by March and April and May with a historic mortgage rate shock.
Yes.
So it's like, you know, I take these forecasts I take with a huge grain of salt.
Okay.
And I mean, I'm sure you probably do too. Uh, but it's interesting to kind of see the trajectory shifts as
Yes.
other data comes in. Because what the forecasts are doing is looking at a ton of economic data and then reading it. So I
Mhm.
think some of the shifts are interesting, but I take them with a grain of salt.
Yeah. Well,
And,
Lance,
and
you do an
yeah,
amazing job. I
I do
appreciate
want to
everything
say
you
one
do.
more thing.
Oh, please go ahead.
I asked Sandy his view on the spread.
Oh.
And his view is he doesn't think the spread's going to come in much until the Fed is actually cutting rates,
Oh,
recession or
that's
cutting
interesting.
rates. And I asked pause and done being rates. He still thinks it actually has to be a cutting of the rates. So it'd be interesting to see if that's true. The models have thought that the spread would come in through the year fairly quickly by the end of the year. But then again, the rates never even detected the spread would happen last year.
Exactly.
Would
Yeah.
spread. So I don't know, but it's kind of interesting to see these different thoughts and takes.
And folks, if you don't know what the spread is, this is basically the 10-year to the average mortgage rate. You should really follow Lance on Twitter. He's reporting this daily for you. I think the last reading was 313 basis points, where historical average is about 175 or 180. So you have an extra 1.5% spread there. Lance says all things housing all the time. Please follow him on Twitter. How can they find you on Twitter and your Fortune articles?
Yeah, if you want to read my Fortune articles, Google Lance Lambert Fortune. If you want to find my Twitter, search for @newslambert on Twitter. And if you want to hear some of my takes, one rental at a time, every come on every week.
Yeah, he has his own playlist. Just look up Lance. It's that simple. Thanks, buddy. I appreciate you.
Thanks, Mike.